I'm Dickinson Bransford, Managing Director of Investment Bank Mid-Market Securities. I also write a business ownership column for thomasnet.com, the 120-year-old business-to-business marketplace. In this COVID-19 economy, many companies are going to need operational and/or financial restructuring or other solutions we offer, most of which fall into four basic categories. The first is debt financing, the second is selling or merging the company, the third is acquiring others, and the fourth is taking equity capital investment. I'll describe each in a few sentences. If your company needs a loan or cash flow solutions, we can access debt mechanisms that will be far more flexibly structured than what a bank can offer and with higher limits. Now, I would never suggest that a company take on debt to solve an unsolvable problem by kicking it down the road. But there are times when debt is the perfect choice, and especially so in a low interest rate environment. If you're considering selling or merging the company, we can lead and manage the complex process of confidentially preparing the company, seeking and contacting appropriate parties that would see the optimal value in your company, then negotiating a successful transaction on your behalf. If you're in the position to acquire, we can offer a very efficient outsourced corporate development solution. Based upon agreed criteria, we'd seek and vet appropriate candidates, then work to negotiate favorable price and terms on your behalf. And the fourth is equity capital, which comes in basically two forms. The investors either take a majority ownership position in your company or a minority ownership position in your company. Minority ownership, which is also known as growth capital or growth equity, is available to fast-growing companies or those with the potential to be in attractive categories. Frequent uses of private equity investment funds or family office investment funds would include management buyout or buy-in, shareholder buyout, family intergenerational transfer, or a majority recapitalization, in which the existing shareholders would divest part of their wealth tied up in the company, but then operating shareholders and their team would continue to run the company for several years with incentives for growth and, critically, the financial backing to support that growth, along with the resources of expert board-level directors with industry experience in most cases. After approximately 5 years, the shareholders would collaboratively sell the company, but now this is a larger, more valuable company. So the original shareholders would reap a second gain on the sale, which often exceeds the value of the first gain, and the management team would reap the rewards of their financial incentive program. This can be a great way to reward high-performing, loyal employees. And occasionally, though uncommon, a private equity investment can be combined with an employee stock ownership plan or an ESOP. Now, just to be clear, the investors that I'm describing are only interested in funding growth. They're not interested in buying companies at a fire sale valuation and then underinvesting in what it takes to move them ahead. When I represent a client, I set two goals. The first is to conduct efficient, well-planned, methodical transactions that'll attract the highest valuations, best available terms, and have the highest likelihood of closing. And then the second is to deliver value far in excess of our fees. If any of this resonates with you, please contact me at either mdb@mmsib.com or area code 415-294-0002.